Today we're going to talk about a stock called Xometry, and the title of the slide here says Xometry takes lead. Well, takes a lead in what? Well, what we refer to as distributed manufacturing, others call different names such as on-demand manufacturing, manufacturing as a service, digital manufacturing, etc. And what this refers to is when a company has a manufacturing need, and instead of doing that in-house, they outsource it to a provider such as Protolabs, that their business model is around doing the work themselves in-house, and we always believed that that was the superior business model because they'd be able to control quality and have a closed loop that they could learn from. Well, it turns out that the optimal business model is probably one like what Xometry uses, which is to farm that work out and to simply use AI algorithms to price the jobs up front. They actually take that risk and then they farm that out once the company has decided to purchase the manufacturing job. So this particular area is ripe for growth. There's a very large total addressable market, and there are 5 stocks that you can invest in, and 3 of those came about during the SPAC movement. You can see the names here circled in red. You have Fast Radius, Shapeways, and Fathom Holdings. All 3 of these we covered and advised investors not to get associated with them. And the first company that we're going to talk about is Fast Radius, which went bankrupt last week. That means that the price of their shares went from $10 a share to 14 cents a share. And surprisingly, this was one of the SPACs that Palantir invested in. We were highly critical of the fact that Palantir was taking shareholder money and investing it in essentially speculating on SPACs, though they framed that differently. That $20 million investment that Palantir made is now worth $280,000. That's a loss of nearly 99%. So First Radius ran into problems, and that's certainly a company that we wouldn't take a second look at. Then you have Shapeways. They're in equally as bad shape. They're down 96% from $10 a share to 60 cents a share. It's a $30 million company with no growth. And what's worse, as you can see here, this chart shows the black bars, what they promised investors in their SPAC deck. The green bars are what they actually delivered. So not only is the company not able to keep their promises, but they're also not experiencing any growth. Again, this isn't a company that we would even consider talking about. And you can see here just how lofty the expectations were that they set with investors, and they're being punished for that accordingly. Here you can see this 66% compound annual growth rate looking forward that they certainly haven't been able to realize. And the third SPAC in the list, Fathom, they can grow revenues, you can see here, but they've run into some problems of their own. So they acquired a lot of firms and as a result overpaid and recently had a $1 billion goodwill impairment charge. And we've written before about what that means. Essentially, it just means that they overpaid and squandered the capital that they had on firms that they shouldn't have paid so much for. And in their recent investor deck, they focus on the liquidity that they have, $8 million in cash and this $23 million in an undrawn credit line, which shows that they're really thinking about survivability. Now, revenue growth for this firm has been stagnant over the past 6 quarters, and for 2022, they're expecting year-over-year growth of about 7%, so nothing very exciting. Here you can see how they've been doing a lot of acquisitions. They talk about their M&A advantage. Well, that hardly seems the case with the $1 billion write-down that they had, but you can see they completed 13 acquisitions in 3 years, with 4 completed in 2021. This is taken from their SPAC deck. And then this slide is from their recent investor deck, and you can see here they're spelling out their liquidity. So they have some term debt of $122 million. They have this revolving credit facility of $27 million, so their gross debt is around $150. And then they have cash of $8 million, not very much. Net debt, that's debt net of cash, is $141, and they have this undrawn revolver commitment of $23 million, so that they have around $31 million in liquidity. They're making it a point to tell us this to ensure that we know their focus is on survivability and not running into problems as Fast Radius did. Here you can see they actually have cash being generated by their operations, not much, 2.3 million there in the last quarter, and then their capital expenditures were 4.3. So this is a company that's that should have a nice war chest following their SPAC, but ends up with practically nothing. Again, a company that we wouldn't be interested in getting involved with. Now, when you look at Protolabs, we recently wrote about why we're exiting our position in Protolabs, and this chart says it all. The Q4 2022 there on the chart you see, that's taken from the midpoint guidance of each firm. Look how quickly Xometry caught up. And I think it was towards the end of 2020, we noticed that Xometry was making some great progress, and we went long that firm as well. And now you can see that Xometry has certainly taken the lead in terms of market cap, and soon they'll take the lead in revenues as well. So it's very disappointing to see Protolabs management team not able to execute on their promises of $1 billion by 2026. And then when questioned about that, they sweep it under the carpet and pretend like they never had that goal. That management team is not competent enough to merit an investment. And here you can see Xometry on the right-hand side, the last 4 quarters of revenues and earnings. You see the trends are going in the right direction in terms of revenue growth, in terms of trimming their losses. They now report on 2 segments because they acquired a firm called Thomas Publishing Company, and the intern didn't correctly fill these in. I believe Marketplace, their legacy business, is somewhere around 80% of their total revenues. The services component here, somewhere under 20%. And the margins differ dramatically. So I'll just plug these values in. So for Marketplace, the margin's somewhere around the 40s. And then for services, it's somewhere around 78%. Actually, for Marketplace, it's in the 30s. So blended, that gives them somewhere in the 40s. So if they're able to squeeze their costs, then they certainly might be able to realize profitability. And they say that in their last call, they're expecting profitability to happen in the second half of next year. And they issued earlier this year 2027 convertible notes that raised $287.5 million, and they have somewhere around $341 million on their balance sheet that should help them tide through until they can hit profitability. Interesting note on their recent earnings call, they talk about job acceptance, and they have surprisingly 625,000 manufacturing businesses in the United States doing their work. 75% of those businesses have fewer than 20 employees. That's very interesting. One measure that they take is how long it takes for a job to be accepted. So when they receive a job, they'll price it, and then they'll farm it out to those different businesses. Well, from August to September, jobs were taken at a 36% faster rate as suppliers more aggressively accepted orders. This resulted in the cost of jobs in the marketplace declining at an unprecedented rate, which in turn means their AI algorithms started lowering prices to buyers, which boosted conversion rates but dampened their revenue growth because of that sharp reduction in cost. So they say here they expect that the algos to adjust pricing optimizations to account for this sudden change, and that will grow their revenue per buyer early next year, helping them to resume their growth. If you noticed in the last quarter, the growth wasn't as sharp as you would typically expect to see. So one thing to note there is the accounts that they have that are spending greater than $50,000 for the company, and look at that nice trajectory there. So we see this is that concept of net retention rate. Once a customer starts using their platform, they continue to use it. So just based on the money Xometry has in their books and an average of $20 million, let's say $19 million burned per quarter, this firm has about 4 years of runway. So we're certainly not concerned with survivability. Now, just to conclude, Protolabs has lost their leadership position, and that's very unfortunate. One of the players has gone bankrupt, so there are a total of 4 players left that are publicly traded. Xometry is now assuming the leadership position, both in size and in revenues, at a quarterly annualized revenue measure, and we'll need to see a clear path towards profitability while sustaining that growth trajectory. And we seem to see that just based on the cash they have on hand, the verbiage coming from the management team. But one thing you can be certain of, as we've seen this past year and recently in their earnings report, is that there's going to be a lot of volatility around this stock for no apparent reason. That's just how the tech stock world works these days. So please leave your comments in the comment section. Make sure to subscribe to our channel. Thanks for taking the time to watch this today.